What you doing out here, bro?
I don't know, just trying to be like my hometown hero, Jade McDaniels, working on my fundamentals.
Oh, you're working on your fundamentals. Let me analyze your fundamentals.
It's kind of like fundamental analysis, right?
Damn right. Exactly like fundamental analysis. Speaking of, fundamental analysis is when you look into the 3 financial statements of a company to analyze the company's financial health and financial performance. Statement 1, balance sheet. A balance sheet is a financial statement that tells us about the assets, liabilities, and shareholder equity of a certain company. And this gives us an overview of the entire financial health of the company, which therefore gives us information about the risk involved in the investment. And our 2 main focus points when looking at a balance sheet are the liquidity and solvency of a company. The liquidity is the company's ability to pay off its short-term debts, and the solvency is the company's ability to pay off its long-term obligations. The first major section on a balance sheet is the assets section, and this is split into 2 subsections, the current assets and the non-current assets. Current assets are assets that can be turned into cash in a short amount of time, and this includes things like cash itself, maybe some stocks the company has, and inventory, which is items that the company can sell. And non-current assets take a longer time to convert into cash, and these are things like fixed assets, which include a company's land, buildings, machinery, and can also include long-term investments and patents that a company has. The next major section on a balance sheet is the liability section. And like the assets section, this is also split into 2 major subcategories, the current liabilities and the non-current liabilities. And the current liabilities are short-term payments that a company has to pay out. And this includes things like wages paid to employees, dividends paid to investors, and other types of short-term payments. And the non-current liabilities don't need to be paid off in the short term, but they do need to be paid off at some point in the future. And this includes things like long-term payments on things like buildings, and it also includes interest payments on bonds that they've given out to investors.
Statement 2, income statement. The income statement is a financial statement that tells us the revenue, expenses, and net income of a company over a certain period of time, normally a year. It is very important as it shows us the profitability and growth of a company over that period of time. So a company can have 2 different types of revenue, total revenue and operating revenue. The total revenue of a company is everything that the company makes from their core activities and any other sources of revenue that they have. The operating revenue is everything that the company makes from just their core goods and services that they sell. Next in the income statement is expenses. There are 3 different subsections: total expenses, cost of revenue, and operating expenses. The total expenses is everything that the company pays in the given period of time that you're looking at. Cost of revenue is everything that the company pays to manufacture the goods or provide the services. And the operating expenses is everything that the company needs to pay to operate their business, such as employee wages and rent for buildings. Next is income, and there are 3 different important income values to calculate: operating income, net income, and normalized net income. Operating income is your total revenue minus the cost of revenue and minus your operating expenses. Net income, or your earnings, is your total revenue minus the total expenses, which includes cost of revenue, operating expenses, and your taxes. And normalized net income is the same as net income, however, it adjusts for any non-recurring sources of revenue or expenses that don't happen on a regular basis, so something like a warehouse getting destroyed like a natural disaster. Next are 2 important ratios that allow us to determine the efficiency of a company when using its money. First is the net profit margin, which is your net income divided by your total revenue. And this allows us to determine how much money a company keeps from its total revenue. A good net profit margin is above 20%, and an average is in between 10 and 20%, and anything below 10% is considered bad. Next is our return on equity, or ROE, which is net income divided by shareholder equity. And this allows us to determine how much money a company keeps from every dollar invested by shareholders. So for example, if you had a 20% ROE, you would keep 20 cents per every dollar. The next important ratio is the earnings per share ratio, or EPS, and this is your net income or your earnings divided by the total shares. Now this allows us to determine the total earnings that a company makes for each share of stock. Now you want to compare this number to other companies in the same industry, as the number differentiates from industry to industry. So the final 2 ratios are the 2 growth ratios. First is EPS growth and second is revenue growth. EPS growth is your final EPS minus your initial EPS over your initial EPS. And ideally, you want this to be positive and accelerating from year to year, and you want to compare this number to other companies in the same industry. However, if you would like a benchmark number, the S&P 500 average is around 10%. Next is revenue growth, which is very similar to EPS growth in a lot of ways. However, it is your final revenue minus your initial revenue over your initial revenue. And just like EPS growth, you want this to be positive and accelerating and to compare it in the same industry. However, if you want to benchmark, the S&P 500 average is around 5%.
Statement 3, cash flow statement. There are 4 major categories on a cash flow statement: operating cash flow, investing cash flow, financing cash flow, and end cash flow position. The operating cash flow is the amount of cash a company makes or loses from its core operations. Investing cash flow is the amount of cash a company makes or loses from either purchasing or selling fixed assets or securities. Financing cash flow is the amount of cash a company makes or loses from either taking out loans or paying off loans. And the end cash flow position is essentially a combination of all these 3 up here, and it tells us the total amount of cash a company made or lost within a year. Now, the importance of a cash flow statement is it tells us only about the movement of cash within a business, not any sort of non-cash assets. And why this is important is because 1, tells us the efficiency at making and producing cash of a company, and second of all, more importantly, it tells us about the true financial health and performance of a company. For example, a company could make a lot of money from taking out loans, meaning it would have a very high financing cash flow. However, it could have made no money or lost money from its core operations. This would indicate that a company did not perform well financially, even though it may appear so by the income statement at the net income. Now first, we'll look at cash flow from operations, which, as I said before, is the gain or loss of cash from the core activities and operations of a company. Now, there are 2 criteria that should be met here. First of all, this number should always be positive, and ideally it should be increasing each year as well. And the reason these 2 criteria are important, especially this one, is because it shows that the company's business model itself is actually profitable. Because if the company's business model isn't profitable, then that indicates that the company's growth may not be sustainable and that the company is not going to be a good investment. The next section is cash flow from investing. And this means the gain or loss of cash from buying or selling assets. And the 2 major types of assets in this section are PPE, which means plant, property, and equipment, as well as securities, which include stocks and other marketable investments. Now in this section, a negative number doesn't necessarily mean that it's bad, because the purchase of PPE could show the growth of a company, and also the purchase of some other marketable securities could be profitable in the future, thus increasing cash flow. Lastly, we have our end cash flow position, and this consists of our net cash flow, which is the changes in cash over the year, and the end cash position, or the amount of cash the company has in total at the end of the year. The net cash flow should usually be positive, but it still depends on the other 3 sections. For example, a company could have invested a lot into assets that year, which could indicate that the company would have greater cash flows in the future. However, on the other hand, if the company has negative cash flow from operations, then that could be a cause for concern.
Next, we have 2 different coverage ratios that are important: the cash flow coverage ratio and the current liability coverage ratio. The cash flow coverage ratio is your operating cash flow over your total debt. Now, this allows us to determine how good a company is at paying off their long-term debts with their operating cash flow. An ideal number for this is above 1.5, and an average number for this is in between 1 and 1.5. Next is the current liability coverage ratio, which is your operating cash flow over your current liabilities. Now, this allows us to determine the company's ability to pay off short-term debts with their operating cash flow, and thus kind of shows us the liquidity of the company. And an ideal number for this is above 1.
And now we have our quality ratios, which both tell us how much of the company's money actually comes from its operating cash flow, as well as how reliable the company's earning reports are. And this is important because companies can often use manipulation to change their earning reports and make them appear better than they really are. So first of all, we have our quality of earnings ratio, which is operating cash flow divided by net income. And if this ratio is greater than 1, that's a good sign that the company's earning reports are reliable and there aren't accounting tricks being used to manipulate them, as well as the fact that the operating cash flow is greater than the net income. On the other hand, we also have our price to cash flow ratio, which is the price per share divided by the operating cash flow per share. And this ratio, what you want to compare to the PE ratio, the price to earnings ratio. And if this ratio, the price to cash flow ratio, is significantly higher, that could indicate that the company has a low quality of earnings, meaning that the company's earning reports aren't very reliable, which could indicate that the company may be a bad or risky investment. And next, we have our cash flow from financing section. And this section is about gain or losses in cash from receiving or paying off external funding. Now in this case, just like cash flow from investing, a negative number is also not necessarily bad. And in fact, a positive number could also be bad in this section. This is because a positive cash flow from financing could mean that a company is taking out a lot of loans and therefore increasing their liabilities or debt. While at the same time, a negative cash flow from financing could mean that the company is paying off of their loans and therefore decreasing their debt. So therefore, if a company has a negative cash flow from financing, that could indicate that the company is growing sustainably and therefore is a less risky investment.
In this video, we went over fundamental analysis in the 3 financial statements.
First of all, we went over the balance sheet, and this tells us a lot about the financial health of the company, specifically with regards to its liquidity and its solvency.
Next, we went over the income statement, which tells us about the financial performance of a company and its growth.
Lastly, we went over the cash flow statement, which allows us to check the reliability of the income statement, as well as give us more insight about the financial health and performance of the company. Go to that.